I'm Daniel.
And I'm Mira.
If you were watching the tickers today, you might have honestly thought your trading screens were broken.
Oh, absolutely. It was just completely chaotic out there today.
Right, because there are days where the global economy follows this, logical, predictable rhythm, and then there are days like today.
Wednesday, June 24th, 2026.
Exactly. Every major asset class seemed to be caught in this massive, violent tug of war.
Yeah.
I mean, we stepped into an environment that was simultaneously deeply risk-off and aggressively deflationary.
Yeah, the S&P 500 futures, they saw this incredibly choppy, really whiplash-inducing two-way trading.
It finally closed at 7476.00, but, the real story was in commodities.
Oh, I had a dip.
WTI crude oil absolutely plummeted below $70 a barrel. And gold, it didn't just dip, it plunged aggressively straight through the $4,000 mark.
Right, which is a textbook flight to safety, but it was layered with these incredibly complex, modern twists that, well, completely upended the usual correlation between energy, equities, and central bank policy.
Which is exactly what we are going to break down for you. So here is the roadmap for today's deep dive. We are unpacking a massive wave of global central bank hawkishness, a sudden geopolitical de-escalation that just crashed global oil prices, and the latest artificial intelligence chip alliances that are actively shaking up the entire tech supply chain.
We really are going to connect all these dots so you understand the baseline you're operating against.
Yeah, we have a tremendous amount of ground to cover.
Yeah.
But before we jump into the events that set this all in motion, we need to explicitly state that this show is strictly for market context and discussion.
Right. It is not personal investment advice.
Exactly. Nothing we discuss today is an investment recommendation. All right, let's wind the clock back a bit. Session 1. What set the stage before the U.S. session opened today?
Well, look, to understand the ceiling that was placed on U.S. equities today, you really have to look at what happened in Asia overnight.
Oh, the Bank of Japan.
Yeah, it starts with the impact of the BOJ's June summary, which was actually published late yesterday afternoon, Tuesday, at 4:51 p.m. Eastern Time.
Right around the time U.S. markets were closing.
Exactly. And the tone of that summary was surprisingly aggressive. Bank of Japan Governor Ueda is now clearly signaling a path of continuous rate hikes.
They're aiming toward that 2% neutral level, right?
Right. Their dual mandate right now is aggressively combating domestic inflation while, trying to put a floor under a historically weak yen.
And we saw the market reaction play out almost instantaneously. Domestic Japanese equities were absolutely hammered. I mean, the Nikkei 225 closed down 3.55% overnight.
Huge drop.
It really was. But I want to make sure we don't just gloss over the localized Japanese impact because, well, this has massive implications for your portfolio, even if you don't own a single Japanese stock.
Oh, for sure.
This is a perfect real-world example of discount rates as financial gravity. When Japan raises rates, what are the actual mechanics behind this threat to U.S. equities?
It really comes down to the mechanics of the yen carry trade. Look, for years, the Bank of Japan has maintained ultra-loose monetary policy with essentially zero or negative interest rates.
Free money, basically.
Exactly. Global investors, particularly these large institutional hedge funds, they take advantage of this by borrowing yen incredibly cheaply.
Right.
Then they take those borrowed funds, convert them to dollars, and buy high-yielding U.S. assets. We're talking everything from treasuries to mega-cap tech stocks.
But then when the BOJ suddenly hikes rates,
the cost of servicing that borrowed yen spikes. So to pay back those suddenly expensive loans, investors are forced to liquidate their U.S. assets.
So it violently unwinds the trade.
Right. It acts as a massive vacuum that sucks global liquidity straight out of U.S. equities and pulls it back to Tokyo.
Wow. So before the opening bell even rang in New York, you had this massive liquidity threat hanging over the market. And it wasn't operating at a vacuum either, because we also had significant geopolitical carryover from yesterday evening.
Tuesday at 6:55 p.m. Eastern Time.
Right. Israeli Prime Minister Netanyahu and Defense Minister Katz made a joint assertion that they intend to maintain permanent security control in southern Lebanon,
which openly defies the current U.S. demands to withdraw as part of the broader regional ceasefire framework.
It's an incredibly tense development.
It is, but, if we analyze this through a game theoretic lens, we shouldn't simply view this localized conflict as some unpredictable natural disaster that just happens to disrupt markets.
Right, it's more calculated than that.
Absolutely. You really have to consider geopolitical brinkmanship as bargaining leverage. I mean, we know that a broader reconciliation agreement involving Iran, the United States, and the Gulf states is moving forward.
And in high-stakes diplomacy, you rarely give away territory or concede control right before you sit down at the negotiating table.
Exactly. Asserting permanent control in Lebanon right now might simply be a calculated move to maximize leverage before the final diplomatic hand is dealt.
That is a critical way to frame it. The posturing is the feature, not a bug, of the negotiation process.
Yeah.
But moving back to the domestic front, the pre-market hours were just as dramatic. Just past midnight, 12:13 a.m. Eastern Time today, to be exact, President Trump directed the Department of Justice to launch an active investigation into major oil companies.
He specifically named Chevron, BP, and ExxonMobil, right?
He did, accusing them of intentionally keeping pump prices artificially high and refusing to lower them fast enough to match the plunging price of crude oil.
Which is a significant regulatory threat, and it was delivered while most of the U.S. financial sector was asleep.
Seriously.
But what's fascinating is how the administration balanced that aggressive regulatory stick with an economic carrot just a few hours later.
Oh, you mean Treasury Secretary Scott Bessent?
Yeah. Mid-morning, around 7:34 a.m. Eastern Time, Bessent came out with a wave of sheer macroeconomic optimism. I mean, he forecasted U.S. GDP growth accelerating above 3% and predicted that deficit-to-GDP ratios would drop below 4%.
And he also took time to throw some serious praise at the new Federal Reserve Chair, Kevin Warsh, specifically complimenting him for eliminating forward guidance.
Which is a huge structural shift at the Fed that investors really need to grasp. By eliminating forward guidance, the Fed is no longer holding the market's hand with predictions about future rate cuts.
They are forcing the market to react to real-time data.
Exactly. Furthermore, Bessent emphasized that using dollar strength as imported inflation mitigation is now a core administration strategy.
Let's translate that for the listener really quickly. A relentlessly strong U.S. dollar means that foreign goods, from electronics to raw materials, become cheaper for American consumers and businesses to import.
Right, which inherently helps kill domestic inflation.
So tying all these pre-market threads together, you had a newly hawkish Bank of Japan threatening global liquidity, a U.S. Treasury actively backing a hawkish, no-promises Federal Reserve, and heavy geopolitical posturing in the Middle East. That is an incredibly heavy macroeconomic ceiling.
It really is.
All right, that wraps up our look at the pre-market setup. We're going to take a quick break, and when we come back, we'll dive right into the massive geopolitical catalyst that completely offset this financial gravity. Stay with us.
We'll be right back.
Welcome back to Market Recap. Let's get right into session 2. What moved the markets during U.S. trading hours?
This is the part of the day that honestly completely shattered the standard script.
It really did.
The deflationary catalyst that commodity traders have been whispering about for months finally materialized in physical reality.
The Strait of Hormuz has officially reopened.
Yes. The U.S.-Iran Memorandum of Understanding is no longer just paper. It is fully in motion. By late afternoon today, U.S. Energy Secretary Wright confirmed that 72 massive commercial ships carrying a combined 20 million barrels of oil had safely exited the strait.
Just think about the sheer scale of that logistics movement. I mean, 20 million barrels of oil flooding into the global supply chain in a matter of hours.
And the financial plumbing required to sustain this deal is also activating in real time.
Right. Iran's previously unfrozen funds are now actively moving into escrow accounts via Doha.
We are seeing Qatar and Oman successfully mediating the regional transit talks, and crucially for the shipping industry, there are no transit tolls expected for vessels passing through the strait.
Which is huge.
Yeah.
And the market reaction to this localized geopolitical ceasefire was incredibly violent. I mean, WTI crude crashed 4.8% intraday. It hit a low of $69.63 before eventually closing at $69.82.
What you are witnessing here is the raw power of tail risk removal as the market trigger.
Yeah.
For the past several months, oil futures have been heavily inflated by a geopolitical premium. The sheer terror that a closed Strait of Hormuz would physically choke off global energy supplies.
But once those 72 ships exited the strait safely,
that worst-case scenario just evaporated, and the premium vanished with it.
Yeah.
Ultimately, this dynamic effectively functions as a massive consumer tax cut.
Energy prices as a consumer tax cut, absolutely.
Right. When energy prices plummet, fuel costs drop, manufacturing inputs get cheaper, logistics companies save billions, and consumers suddenly have more disposable income.
I completely agree with the consumer tax cut analogy, but I have to push back hard on the market's reaction to the supply side here, or at least admit that I am genuinely baffled by how traders are weighing the data today.
Oh, because of the EIA report?
Exactly. Right in the middle of this oil crash, at 10:30 a.m. Eastern Time, the U.S. Energy Information Administration released its official crude inventory data, and the data showed a staggering draw of 6.088 million barrels from U.S. crude inventories.
It wasn't just a draw either. It dragged total U.S. stocks, including the Strategic Petroleum Reserve, down to their lowest physical levels since 1984.
1984, I mean, the SPR is structurally depleted. Normally, if you release fundamentally bullish data showing a supply deficit that's severe, oil prices would spike violently upward.
Right.
Yet today, crude plunged. Is the broader market just being completely naive? Like, are algorithmic traders simply assuming that these 20 million barrels coming out of Hormuz today somehow permanently solve a structural, decades-in-the-making supply deficit here in the U.S.?
It is a brilliant paradox, and, well, it highlights a massive clash of time horizons.
What do you mean?
The market right now is trading the immediate visceral relief of the Hormuz supply shock. The sheer volume of 20 million barrels hitting the water today is completely overpowering the slow-moving structural deficit shown in the EIA data.
So short-term news cycle beating long-term physical reality.
Exactly. And while commodity traders were hyper-focused on digesting that oil flood, global central bankers were simultaneously piling on the hawkish rhetoric.
They really weren't letting up. At 11:22 a.m. Eastern Time, European Central Bank Executive Board member Isabel Schnabel came out and explicitly warned that the Middle East ceasefire does not justify relaxing vigilance on inflation.
Right. She stated flatly that European interest rates still aren't restrictive enough.
Which perfectly aligns with what we saw overnight from the Bank of Japan and what we're seeing from the Federal Reserve here at home.
It's a synchronized global wall of hawkishness.
So if we look at the broader tape today, it was this brutal tug-of-war. You had the massive oil plunge signaling rapid deflation and economic relief, violently colliding with hawkish central banks, signaling tighter financial conditions for the foreseeable future.
And that exact combination is what sent gold sharply lower to $3,975.70.
Since gold yields absolutely no interest, it suffers heavily when interest rates stay high and geopolitical panic subsides.
Meanwhile, U.S. 30-year Treasuries caught a massive safe haven bid, hitting 114.22 as investors locked in those long-term yields.
So, to quickly wrap up this session, the U.S. trading day was ultimately defined by that collision. The massive physical relief of oil flowing freely out of Hormuz, crashing headfirst into the reality of global central banks refusing to back down on interest rates.
That's exactly it.
All right, we are going to take one more short break. Up next, we'll explore how corporate America, specifically the AI supply chain and big banks, fared today. Don't go anywhere.
We'll be right back.
Welcome back. Let's move into session 3. What are the key corporate events from today, and what should we watch next?
Let's start with the tech sector, because the physical infrastructure underlying the artificial intelligence boom is shifting incredibly fast.
Oh, you're talking about the Qualcomm announcements.
Yeah, at 2:46 p.m. Eastern Time, Qualcomm made some massive partnership announcements. Microsoft is officially deploying Qualcomm's high-bandwidth compute chips inside their massive Azure data centers.
Which is just a staggering win for Qualcomm in the hyperscaler space,
Yeah.
a space that has been utterly dominated by NVIDIA for years.
And it gets even bigger. Meta also announced they have signed a multi-generation deal for Qualcomm's new Dragonfly C1000 CPUs, which are slated to start rolling out in 2028.
So if you are an investor heavily weighted in tech, you have to look closely at what these hyperscalers are actually doing. We are seeing hundreds of billions of dollars being committed to AI data centers.
But there is a deeply defensive element to these announcements. I mean, we frequently talk about mega CapEx as a market fragility mask.
Right.
While these massive multi-billion-dollar infrastructure buildouts are driving the broader equity market higher, the reality is that companies like Microsoft and Meta are aggressively diversifying away from single vendor dependence.
They are sweating.
Oh, absolutely. They are desperately trying to manage escalating component costs and critical supply chain bottlenecks by actively pitting chip makers against each other.
And speaking of tech sector anxieties, we also saw a major cyber espionage escalation right before the closing bell. At 3:38 p.m. Eastern Time, Anthropic reported that Alibaba was illicitly accessing its AI models. specifically the Claude infrastructure, via an automated, highly sophisticated hacking campaign.
And you have to view this through the lens of the prior session's backdrop. Just yesterday, Alibaba actually sued the U.S. Department of Defense over being placed on a Chinese military company blacklist.
Right, which frames today's hacking accusation as a rapidly escalating U.S.-China tech tension. I mean, the AI arms race isn't just about who can build the biggest data center or secure the most power. It's increasingly about who is covertly extracting whose intellectual property.
It casts a heavy geopolitical shadow over the entire AI boom. But moving from the tech sector over to finance, the big U.S. banks got their ultimate report cards today.
Ah, yes, right at the close. 4 p.m. Eastern Time, the Federal Reserve released the results of its annual stress tests.
32 large banks proved they could successfully absorb over $700 billion in hypothetical severe recession losses.
And their aggregate capital only declined by 1.6%.
Which is incredibly resilient.
They essentially aced the harshest test the Fed could throw at them.
They absolutely did. And from an equity perspective, that resilience paves the way for increased dividends and massive share repurchases across the financial sector in the coming quarters.
You know, contrasting that banking resilience with the energy sector today is almost comical. Oil plummeted so fast after the Strait of Hormuz reopened that you'd think the physical barrels literally rolled off a cliff. Yet despite WTI crashing below $70, President Trump is still investigating Chevron, BP, and Exxon for not dropping pump prices fast enough. Honestly, the only thing dropping faster than crude right now is the energy sector's stock performance.
It's true.
I mean, if this deflation keeps up, energy investors might have to politely ask Iran to close the strait again just so they can afford to fill up their own gas tanks.
It really was a historically brutal day for energy equities. But looking ahead, the macroeconomic calendar offers absolutely no time to catch our breath. Let's outline what investors need to watch next on Thursday, June 25th.
Yeah, tomorrow brings one of the heaviest economic dockets of the entire quarter. Right at 8:30 a.m. Eastern Time, we get the Federal Reserve Preferred Inflation Gauge, the May PCE inflation data, along with core PCE.
And simultaneously, we get the Q1 final GDP third estimate.
Right, plus weekly jobless claims, May durable goods orders, and the latest data on personal income and spending, all of it dropping at exactly the same moment.
Which guarantees a highly volatile morning session. And that massive data dump leaves me with a lingering question for you to mull over as you review your portfolios tonight.
Let's hear it.
We just saw a localized geopolitical ceasefire do the heavy lifting of killing global inflation by crashing oil prices.
Yeah.
But will that sudden deflationary relief give central banks a false sense of security?
Oh, that's interesting.
Could this structural commodity crash cause them to keep interest rates too high for too long, right at the exact moment when the AI infrastructure boom demands unprecedented capital and liquidity to survive?
That is the multi-trillion-dollar question that every institutional desk is trying to model right now. All right, that wraps up our main daily discussion.